The UK inflation rate was 10.1% in October 2022, the highest since 1991, but it beat the forecast of 10.5% by analysts. What does this mean for the UK economy and its recovery from the pandemic? Inflation is the general increase in the prices of goods and services over time. It reduces the purchasing power of money and erodes the value of savings. A high inflation rate can have negative effects on the economy, such as lower consumer confidence, higher interest rates, lower investment, and lower economic growth. However, not all inflation is bad. Some inflation is expected and desirable in a healthy economy. It reflects the increase in demand for goods and services as the economy recovers from a recession or a shock. It also encourages spending and borrowing, which stimulates economic activity and creates jobs. The UK inflation rate has been rising sharply since the start of 2021, mainly due to two factors: the base effects and the supply chain disruptions. The base effects refer to the comparison of current prices with those of a year ago, when they were depressed by the lockdown measures and low oil prices. The supply chain disruptions refer to the shortages of raw materials, labor, and transport caused by the pandemic, Brexit, and other global events. These factors have pushed up the costs of production and distribution, which have been passed on to consumers. The UK inflation rate was expected to peak in October 2022, according to the Bank of England and most analysts. However, it came in lower than expected, at 10.1% instead of 10.5%. This was mainly due to a slower rise in food and fuel prices than anticipated. This suggests that some of the inflationary pressures may be easing or temporary. This is good news for the UK economy and its recovery story. It means that the inflation rate may start to decline in the coming months, as the base effects fade and the supply chain issues are resolved. It also means that the Bank of England may have more time and flexibility to adjust its monetary policy, which affects the interest rates and the money supply in the economy. The Bank of England has been signaling that it may raise its key interest rate soon to curb inflation and support the pound sterling. However, it may not need to act as quickly or aggressively as previously thought, if inflation proves to be more moderate and transitory. Therefore, the UK inflation rate beating the forecast in October 2022 is a positive sign for the UK economy and its recovery from the pandemic. It shows that the UK economy is resilient and adaptable, despite facing many challenges and uncertainties. It also shows that the UK economy is growing and expanding, creating more opportunities and prosperity for its people. The Bank of England raised interest rates by 0.25% to 4.5% in May. This was the highest level since 2008, when the global financial crisis hit. Why did the central bank make this decision? And what does it mean for the UK economy? The main reason for the rate hike was to curb inflation. Inflation is the general increase in the prices of goods and services over time. It erodes the purchasing power of money and reduces the real value of wages and savings. The Bank of England has a legal mandate to keep inflation close to 2% per year, as measured by the Consumer Price Index, CPI. However, in recent months, inflation has surged well above the target. In April 2023, CPI inflation reached 5.1%, the highest rate since this was mainly driven by higher energy and food prices, as well as supply chain disruptions caused by the pandemic and Brexit. The Bank of England expected inflation to peak at around 6% later this year, before gradually falling back to 2% by late. To achieve this, the central bank decided to tighten its monetary policy. This means making borrowing more expensive and saving more attractive, to reduce the demand for goods and services and slow down price increases. By raising interest rates, the Bank of England also signaled its confidence in the strength of the economic recovery, which has been boosted by the successful vaccination program and the easing of lockdown restrictions. However, the rate hike also carries some risks and challenges. For one thing, it will increase the cost of servicing debt for households, businesses, and the government. This could dampen consumer spending, business investment and public spending, which are key drivers of economic growth. For another thing, it will make the pound stronger against other currencies, which could hurt UK exports and tourism by making them more expensive for foreign buyers and visitors. Therefore, the Bank of England has to balance its inflation-fighting objective with its growth-supporting role. It has to carefully monitor the economic data and adjust its policy accordingly. It has also stressed that any further rate increases will be gradual and limited, and that it will not withdraw its stimulus measures too quickly or too sharply. The Bank of England's rate hike is a significant step in its response to the inflation challenge. It reflects its commitment to maintaining price stability and credibility in the eyes of the public and the markets. It also shows its optimism about the prospects of the UK economy after a difficult period of uncertainty and disruption.